go to our next caller, Paul, who's also in Melbourne. Hi, Paul.
Hello, how are you?
Hi, very well. Thanks for joining us tonight.
Thank you. I was just wondering what you thought of Origin Energy.
OK, now that one I'm sure we can talk about. Down by 1.8% today. Look, one of the many companies to report, gentlemen, to the market. First half profit coming in at $371 million, which was down 94% on last year. That is a lot. Higher expenses, lower production volumes in its exploration segment contributing to the fall in profit.
A caller rang in about this stock a fortnight ago when I was on the show, and I said at that time I thought it was expensive. The results have only come out, so I haven't put the new results in, but I can do that for you viewers, and we can talk about it again when I'm on next. But it was expensive then. Profits down 94%. You know, I'm glad I thought it was expensive at the time, and I don't suspect that's changed if it's only down 1.8% today. It was one of the ones that we said a fortnight ago that I thought it was above its valuation.
OK. All right, gentlemen, we're going to move on. $16.50 is what it's at today. To our next call, we've got Abe in Sydney. Hi, Abe.
Yeah.
Hi, what's your question for the panel?
Yes. Hi, this is Nina. Oh, Nina, thank you for taking my call. My question is about Oil Search. Where does the panel think Oil Search is going from here? Thanks.
OK, Roger, Oil Search.
Oil Search, what's its price right now?
We will try and get the chart up for you.
528? Is it? Around that?
Yeah, I think it's... I think, and I have to go back and have a look at... I didn't bring it with me tonight, but I actually think it's trading at almost double its value. Really expensive. What I might do is, I'll put it up on the blog, and I'll do that tonight when I get back to the office. Yeah, I think it's almost double what it's actually worth, but I'll run the numbers. I'm
going to go to my next caller now, who's in Newcastle, and we've got Daniel on the line. Hi, Daniel.
Hi, Nina. How are you going?
Hi, very well, and thanks for calling in.
I just got a question with Toll Holdings. I'm a little overweight in that stock in my portfolio, and also Wesfarmers, and I was thinking of taking a bit off and moving it into Rio. And considering what's happened to Toll today, I just wanted the panel's opinion on what I should do with my Toll stock.
I can tell him a lot. Daniel, let's talk about Toll first. So it was Toll, Wesfarmers and Rio.
He has Toll and Wesfarmers. He's wondering if he should get
into
Rio.
Yeah. OK. On Toll, I've got a value. I can tell you, look, it's a mediocre business at best, and I think its value hasn't changed really that much in the last sort of 4 or 5 weeks. I've got a valuation on it of $4.80 at the moment, going to $5.58 in 2011 and $6.37 in 2012, and it's trading at $7.12. So for me, sitting in my home office and managing my portfolio, I wouldn't even bother looking at this. And its return on equity is fairly mediocre. I rank companies A1 to A5, B1 to B5, C1 to C5. It's a B3, so it's right in the middle. It's not a great business. I think it's expensive compared to its current price. You have to wait a long time for the value to catch up. It's not going to catch up even in 2 years' time. So that's one I wouldn't own. Now, that's not advising Daniel to go and sell it, but I'm just giving my opinion about what I think. Wesfarmers is worth between $11 and it's going to shock everyone, but it's worth between $11 and $14.
Ouch, because it's $31.16 at the moment.
Yeah. And that value hasn't changed that much since it bought Coles. So that my value's been around the sort of $20 mark when they first bought Coles, and the shares were trading at $44 at the time. Then, of course, they dropped down to $14.25. They did capital raising, I think, at $14.25. I think the shares dropped to $17 or thereabouts, but they did the capital raising at a very generous price. It is expensive. I can't make the numbers get anywhere near the current price. It reminds me, and I'm not saying Wesfarmers is anything like ABC Learning Centres, because it isn't, right? But the focus on ABC Learning Centres before it collapsed, for years before, was a focus on growth. Growth in earnings, growth in revenue, growth in profits. The story about Coles and Wesfarmers today is exactly the same, in the sense that it's all this turnaround story, grabbing market share from Woolies and all that sort of stuff. So there's momentum behind it. It's a good news story. They're turning around. Kmart's going really well. Target's doing okay, you know, so on and so forth. So it all looks good, but the focus is on the wrong thing. The focus is on the growth in profits and not in the profitability. And the profitability of this particular company is quite low, because they paid $20 billion for Coles, which was double what I would have paid for it. And even if they turn it around, there's just not enough value there.
Okay, so given that the question is...
Now, would you jump out of that and into Rio? Right. Well, you're jumping out of the frying pan and into the fire, because Rio is really expensive compared to its value as well. If I really believed in the China story and it was a toss-up between Rio and BHP, well, I'd go for BHP, because I think it's the better business. It has less intangible goodwill on the balance sheet, it has less debt, and it's cheaper compared to its value, and Rio's way over the top in terms of its price.
Now, John from Mackay, our next caller. Hi, John.
Hi, Nina. How are you?
Hi. Great, thanks.
I just wanted to know what the panel thought about Brambles. I've been in it for about 12 months, and they seem to be linked to that US dollar. They seem to go the opposite way to when things seem to be going. What are your thoughts about Brambles?
Yeah, Roger.
When I was a kid, I used to ride a BMX, and there was a show called
That's
E.
very cool.
Do you remember E.T.?
Yeah.
Do you remember the show E.T.? And everyone got milk crates, and they strapped them with the Oki strap to the front of their BMX handlebars. I had one of those, and we used to make jumps to jump our BMXs, and we used CHEP pallets.
Oh, okay. I thought that was going there.
And I don't know.
I was wondering what you use your CHEP pallets for.
I have no idea how they keep track of those things. It's a mediocre business. Modest return on equity. It's not an A or a B stock for me. You know, it's just not in my universe.
Owen?
I'd agree. Actually, many moons ago I used to work for Brambles, and it's just one that I don't follow it at all. I find the business a little bit muddled as well, and I'd probably be, not that fussed either way with it. We
have a problem in Australia. We have a dearth of great quality businesses, and so people are forced to look outside. You know, if they're not patient and they're not willing to wait for great businesses to become cheap, people will often try and buy the second best thing.
Well, with that in mind, just how many businesses do you have on your A1 list?
There's about 40.
Right.
40 out of... There's currently 1,874 listed company securities. There's about 600 that make a profit out of those 1,874. And out of the 600, the ones that I'd class as A class, there's about 40 of them.
What about A1s?
A1s, I'm scared to say, but it's about 20, I think it's 23.
Oh, okay.
22 or 23.
Oh, very interesting. Well, maybe we'll get some calls on them tonight.
Okay.
We're going to go now to Sean from Melbourne. Hi, Sean. Thanks for waiting.
Evening all. Look, I'm a hybrid investor, so I do a lot of sort of hybrid stock buys. Bought yesterday some Guns PA, basically on the back of a massive sort of decrease on that particular hybrid. I've noticed today they've up 6%, and I know there are more high-risk hybrid. I'm just wondering, though, whether or not I should sort of continue to hold this one long-term or sell off when it starts to get back up around the 70 mark.
Yeah, look, really, the investing in preference shares and hybrids is something I know a little bit about. I bought a lot of Australand prefs and the multiplex sites back at, happy days of sort of $30 and $35, and I still have some. The interesting thing about this, though, is when you're investing in these, you have to ask yourself what is the company's ability to continue making its obligations on these. And the other thing that I often do is I often ask myself, well, do I like the business anyway? And Guns, for me, and I appreciate the reason why there's an opportunity there is because Guns obviously has been thrown around a little bit in terms of its share price, and a lot of these securities trade like shares, and therein lies the opportunity. I wouldn't particularly buy Guns because I like wombats, and the company doesn't seem to like wombats that much, and so it's just not one that I'm that interested in. Having said that, it's really simple. You ask yourself, what's the yield to mature, the hypothetical yield to maturity that I'm going to get at the particular price, and does that yield to maturity cover what I perceive as the risk? Now, what's the risk? You take the Guns stock, So you take the ordinary shares and you ask yourself what the value, so this is what I do, I say what's the value of those shares and where is the share price today? And if the share price is above the value, well, the risk is very high. So I want a really high yield on the prefs or on the hybrids in order to cover that. With guns, I'm not sure it's there, but I can have a look at it.
Don't go anywhere. Back with more of your questions in just a minute.